For information purposes, I was informed that a member of the public drove 2 hours to speak to us on an item which we moved up on the agenda, which was item 8. So they had, she drove 2 miles to speak on the item. What did I say, 2
hours?
2 hours, yeah. So, and then we moved the item, so she missed the presentation, which she can capture on videotape. So I would like to take this public comments at this time before we move to item 5. And this is Jane Fosberg on Fossil-Free California. And I would encourage you, Ms. Fosberg, to reference our presentation of item 8, which will be online video. You might find it informative.
Okay, yes.
Especially how we're thinking forward on an issue that's so important to you and so many other people.
I'm sorry I missed it.
That's okay, you'll catch it on video. So we'll take your comments now.
Okay.
3 minutes.
Okay, thank you very much. I've come here today with a very heavy heart. This is the 5th year that Fossil-Free California, representing thousands of California educators, has attended these meetings. We have warned of the impending existential threat of climate change, and we have warned of the huge financial risks of continued fossil fuel investments. Yet our warnings seem to have fallen on deaf ears. We are not only running out of time, but our trust in the system is crumbling. The Green Initiative Task Report presents CalSTRS as the leader of environmental stewardship, and yet CalSTRS continues to invest $6 billion in an industry that has no intention whatsoever of changing its business model. Your preference for engaging with fossil fuel companies has not produced the results needed to deflect the urgency of the crisis. In an email to me in 2014, Jackie Innes highlighted a successful outcome of shareholder engagement. ExxonMobil had decided to report how it would assess the risk of stranded assets from climate change. Has this reporting encouraged Exxon to even consider transitioning to renewable energy? Not one iota. ExxonMobil has recently outlined an aggressive growth plan for the next 10 years to triple its daily production. These are the 10 years when CO2 emissions have to be reduced by 45% of 1990 levels. Exxon also plans to expand production in Guyana and start up 25 new projects worldwide, all made possible by investments like yours. CalSTRS, enough of engaging with fossil fuel companies. As Beavis Longstreth, former commissioner to the SEC, explained in 2015, engagement with institutional investors gives the fossil fuel giants the protective cover they need to stretch out the transition process to renewables for as long as they can. It legitimizes talk over action. Why else is our trust in the system waning? In 2016, one of your committee members, Thomas Unterman, correctly concluded that if CalSTRS adheres to its belief system, it would no longer be invested in ExxonMobil. Yet it still is. And in an interview with ABC that same year, Chris Ailman claimed that as far as engagement was concerned, ExxonMobil is a lost cause. I get that, he said. Why on earth then was CalSTRS staff not instructed to divest from the Exxon after engagement with the company had been exhausted? Members of CalSTRS Investment Committee, you have an incredible opportunity right now to do good. An opportunity to reassure the young people who are rising up for, marching for, and even striking for climate action. You can show your commitment by prudently withdrawing their teachers' pensions from the industry that has no intention of protecting their future from unimaginable catastrophe, no matter how long you continue to engage with them. Thank you very much.
Thanks, Ms. Fosberg. I believe Mr. Fosberg also wants to address the committee. We'll take your comments now. Thank you.
Yes, good morning. A shift here, but anyway. Thank you very much for the Green Initiative Task Force annual report. There's much good work here, lots to be pleased about. It's thorough and detailed, yet I'm also puzzled and saddened by it. First of all, the report is sprinkled with many visual images of lush, natural settings. Pages 6, 7, 10, 11, 16, and so on show green earth, plants, trees, and lawns. So according to the report, clearly we are on our way to a lush and verdant future. Who would guess from this report that within 10 years, unless we take drastic action, we're headed for climate catastrophe, that those verdant scenes will be ravaged by droughts and floods? Where is the urgency of or any acknowledgement of a climate crisis in this report? The section on Climate Action 100 cites the need to, quote, curb emissions, and the image on page 21 shows a clean, orderly pipelines under a bright, sunny sky. Not a spill, not a flare, not a cloud of smoke. What evidence do we have that oil and gas companies will curb their emissions? I didn't see it. Another theme is, of course, the need for increasing disclosures of climate risk. We need to go beyond mere disclosures. We need to insist that top emitters reduce that risk by limiting the greenhouse gas emissions. The chart on page 27 shows the world natural catastrophes accounted for $330 billion in losses in 2017. That's more than our fund. And 10,000 human deaths. The chart trends upward. Recent California fires and floods, the Midwest floods, the African cyclone, all offer evidence of that upward trend. The cause is, as we know, CO2 emissions. What is CalSTRS doing, and what are companies doing beyond disclosures to combat that trend? I was elated, by the way, to see that the CalSTRS new carbon fund, thank you very much for doing that, had returned a 14% return in its first year. I find it ironic then with that news that we're still chasing Exxon's dividend of not 14%, but 4.1%. And Chevron's dividend this year is 4.2%. Even our fixed income asset class, as reported in the thing, earns 4.7%. Engagement's a common theme of the report, yet where is there any evidence that engagement will inspire a fossil fuel company to alter its primary business plan, to extract, sell, and burn all the carbon that it can? If we don't do something, we will be not at 2 degrees, we will be at 4 degrees. Business as usual by the top emitters will destroy our planet and our pension fund. Thank you.
Thank you, Mr. and Mr. Fosberg. And to the extent appropriate, I would ask the appropriate staff to follow up directly with Mr. and Mrs. Fosberg to have any conversation that you deem right. Okay, thank you very much. So item 5 is June Kim and Scott Chen, second part of a conversation around benchmark and risk budget education. Welcome, Scott. Welcome, June.
Great.
And happy opening day. I know that's important to you. I know that's important to many of us, June.
Thank you.
Yes.
Well, good morning, Investment Committee, members of the board. This is part 2 of a benchmark education, which we began in the last board meeting. And as you recall, during that meeting, June Kim presented a risk budget education. We decided to combine the 2 topics because the discussion around benchmarks naturally led to the discussion of risk budgets. So this is a pyramid that I think captured a lot of attention during the last board meeting, and I wanted to show it again and maybe just go through it a little bit. As you recall, benchmarks we defined as an objective standard to measure performance, and we measure performance across the total portfolio, at the total fund level, across the asset classes, and even the individual managers. So if I just walk through some of the layers of the pyramid, you'll understand what the roles are and who does what within the pyramid structure. So the very top, the most important decision we make is the asset allocation decision. And the board is currently going through an asset liability study to set that asset mix, which will be the will set a percentage mix for the asset class strategies. And an example that might be global equities, right? So an asset class, how much would we decide to allocate to global equities? If we go down, what are the policy benchmarks for global equities? On an international basis, that's the MSCI X US. And on a US basis, That's the Russell 3000 index. So we then go down further in the stack. In the investment policy statements, we're setting the sub-strategies, 27 asset class policy sub-strategies. And in global equities, in this example, that would be the split between active investment management and passive investment management across the regions. So everything above that line, and I think this is what captured a lot of the board's attention, as well as was a bit shocking to Chris to see that the board is making 55 decisions related to benchmarks. And everything below the line, 450 decisions are made by staff. And these are the decisions that would relate more to selecting the individual benchmarks for the individual managers. So we had a good discussion, a healthy discussion, and I think one of the ideas that several board members suggested was, is there a way to move the line upwards and delegate more of the benchmark process to staff and to place the board in a more strategic role? So this is not a proposal, but I think it's another approach. It's an example of moving that role of responsibilities upward. So the board would be at a more strategic level, setting the asset allocation, the mix between the different asset classes, and that's really 93% of the risk. It's the most important decision. It's the decision that is going to fund roughly 60% of the liabilities. And then everything below the line, which represents about 7% of the risk or the volatilities and describes the return, would be delegated to staff. I wanted to just provide a bit of a governance framework so that the board can understand the approach. What's in the red boxes is essentially what the board decides on. The board, as you can see, the most important decision decides on the strategic asset allocation. And you've delegated the implementation of that strategic asset allocation to staff. And what aligns our implementation to the most important decision, the strategic asset allocation? Investment policies, compensation policies, and potentially a risk budget. Now, we currently don't employ a risk budget, but it could be a very useful governance tool for us to broaden and explore. If we think about our evolution as an organization and as an investment team, we've evolved into a larger organization and with more complexity. So we had been investing in public assets, public markets initially, and we've branched out and are investing more and more in private markets and alternative assets. We're global investors. We invest all across the world. We've been taking more of the assets internally to manage, and now we're executing the collaborative model. So now might be a good time to continue to evolve our governance structure. I think in the past, our governance structure has been a real competitive advantage for us in the delegation that the board has provided staff. And if we evolve, I think it will continue to maintain and give us that competitive advantage. So what is a risk budget? I think the best way to describe it is just by providing an analogy. And in this analogy is an orchestra. In the orchestra, we need to hire musicians. So there's a couple different ways we can do that. One way is that we could set a certain salary amount and a range of compensation around that salary, say $100,000 plus or minus $20,000 to hire each of the musicians. That's similar to an investment policy where you're specifically setting constraints. A risk budget, on the other hand, would be another approach where you could set a total budget. Let's just say, in this case, it would be $1 million. And we might spend a little bit more for an oboe player because they're difficult to find, or less for a drummer, as an example. Both of the approaches, I think importantly, would reach the same conclusion, which is to adhere to a $1 million budget. But in this second approach, you're providing more flexibility in order to hire, to differentiate and hire musicians at different levels. I think one of the important concepts too is that reaching the same level of point or risk. So in what we're trying to achieve, we're not saying one approach is better than the other. We want to have an investment policy and an active risk budget and to work together in concert to the degree that we can achieve more flexibility, but at no added risk. So we talked about a risk budget in that example in terms of a dollar amount, but in practice, a risk budget is going to be set as a percentage range. And so this chart shows historically in the bars our outperformance or underperformance compared to our policy benchmark. It's a relative return. And in the blue shaded area, that is the range. It's 1.6% that we've averaged in terms of the movement of that relative performance. So that 1.6% or that blue range would be like us setting a risk budget, and that's just the historical range. So as you can see, over short-term periods, and particularly inflection points in the market around 2008, that sometimes your actual performance is going to be above or below that risk range that you might set. But over the long term, you can certainly target risk with a lot higher predictability. And that's what we would seek to achieve. Feel free to ask questions as well. I know we're running through the slides, but if you have questions throughout, feel free to ask. Oh, okay, sorry.
It's okay.
Sorry. So another benefit of a risk budget is, I think, just a natural assumption that when you set a risk target, and our risk target is 40 basis points over our benchmark, that you would naturally set a risk target. How much risk are you going to take to achieve that return target? And in the gray box, what's in the dotted lines in that square, that's the active risk we're currently taking. And you can see that in order to achieve the target, we would actually naturally most likely take a larger amount of risk. So it's important where we are today in the sense that we're setting a strategic asset allocation, and it would be very natural for us then to set an active risk budget or a range around that in order to align with the return targets that we look to achieve. And it goes beyond just setting risk and return targets, but a risk budget would help us, as we saw in the diagram, align all implementation. So I just want to summarize a bit before I hand it off to June Kim to give you a tangible example. I think when we give you the tangible example, it'll really come to life. But we think that a risk budget is important because it will help align implementation with, importantly, what the board is setting as a strategic asset allocation. Secondly, it's going to provide greater flexibility for staff to make decisions on the opportunities. We're not looking for an increase in risk, but to allocate our capital more efficiently. And I think fourthly, it's a good time in our evolution to think about expanding our governance tools and governance structure because we have become much larger and more complex as an organization.
Thank you, Scott. June, I think you're now going to give us some practical examples relative to the global equity portfolio.
I will carry on this
Yeah,
discussion.
thanks.
Thank you, and thank you, Scott. As Scott just said, we have evolved as a portfolio. What worked very well for a simple global equity portfolio is perhaps a good time right now to take a look at the portfolio has evolved, so how could maybe our policies evolve with it to provide the maximum flexibility so that we can eke out the best returns that are available. And if we look at the concept of an active risk budget, so the board setting one number, this is how much risk this portfolio can take versus your policy benchmark. So you would set that at the global equity level. What would remain the same in that type of scenario? What would remain the same is that the policy benchmarks are the same. The board would set those, and we don't see those changing from what they are now. And the primary objective of the asset class remains the same. You set the excess return target, and our objective is to meet or beat that target. The other things that would remain the same are other programs that we currently do in global equity. So we have focused integration and application of the ESG policy. We have a very well-known developing manager program, and the list of prohibited securities that are established by our Committee on Responsible Investing. None of those things change in terms of the implementation. And even the active risk of the portfolio, the amount of risk that we take in the portfolio versus the benchmark, we don't anticipate that changing either. So then what would change? What is this different scenario under active risk budget? I think a picture would do well here. This is our current global equity structure, and we start at the high level global equity, but we have a very regional approach, US, non-US developed in the middle there, and emerging markets. Right now, our global equity policy sets fixed target percents for active exposure and passive exposure. It's 30% active in US, 50-50 in developed markets, and emerging markets is 100% active. And so these are in our policy, and we have ranges around these targets, but still you can see it's a very discrete and regional approach that we're taking. And the benchmarks set in our policy are at each level: global equity, US equity, active passive, non-US active passive, and then emerging markets. So there's several benchmarks that are being set by the board within our global equity policy. If we were to move to an active budget approach, we would get more flexibility with these types of constraints. So right now, we have 100% emerging markets active, which is the bottom right-hand corner. But if we were to move to an active risk budget, I wouldn't be hard constrained by these active passive figures, and we could potentially add a passive emerging markets exposure, just as long as in aggregate that the entire portfolio still remained within the pre-designated active risk budget. So we would have flexibility in that region of the portfolio. We would also have more of a passive to active risk continuum. So as opposed to sticking to hard number targets for US passive and active, we could move more flexibly within each region, depending on where the most attractive opportunities are. One specific example I would give right now, so since our policy right now is 100% active in emerging markets, if the weighting in that region gets a little low, we are forced to reallocate into another active emerging markets manager, just the way that we're structured right now. However, we have a very large portfolio. We have a very large portfolio in aggregate and also just dollar-wise in emerging markets. We think that if we don't find a very top tier or attractive emerging markets manager, it would be nice to have the flexibility to perhaps park some of those assets in passive emerging markets and seek out an active manager in a different region where we may think that we have a better opportunity in a different region given the market environment or given the availability of active managers that are out there. So you see that we move from these hard constraints to more of a passive to active continuum. And it goes back to the summary that Scott was saying is and the last thing that I do want to point out, all the different policy benchmarks that I had stated earlier, that line would be raised up to just where that red line is so that the policy benchmark that's set by the board is at the total global equity portfolio level. Now, even though the policy and the benchmark gets raised, that doesn't mean that the underlying portfolio deviates too much, because the parameters that you're setting in place this is how much risk you're able to take versus your benchmark. And this is also the return that you have to achieve versus your benchmark. Those are two pretty overarching and tight parameters, and it's only within those parameters that we could move between this passive and active continuum. And so within those parameters, you will not see huge deviations, but it will allow us more flexibility than we have currently. And I think this sums up what we've been talking about, moving to a risk budget approach. It provides more flexibility, and it It positions us better, I believe, as investors so that we could be more nimble to respond to changing market environments and different opportunities that may present itself over time. I'll hand it over to Scott for conclusions.
So I think we've been able to present, hopefully effectively to you today, the four main takeaways, which is, a risk budget, the four main takeaways today, which is that a risk budget would provide alignment between the strategic asset allocation that the board sets and providing a risk range around that for us to be, to provide a constraint around. It would help us provide more flexibility for us to invest in investment opportunities at a ground level, but at no additional risk to the fund. And I think importantly today, where we sit today, given the evolution of our fund, larger, more complex, and moving towards executing the collaborative model, it's a good time for us to add this governance tool, additional governance tool. So I did want to mention that, again, this was an information item only, but what we hope to ask the board is for further direction. This is a very extensive topic, and we would be very happy to study it.
Thank you, Scott. Thank you, June. We do have questions from the committee, and we will certainly be giving some direction after the questions or comments from the committee. Sharon.
I would just love to hear from maybe from Alan, from Mika about, just about your thoughts about, we delegate, I think that's one of the challenges for our investment committee is we delegate so much authority already. And so it sounds like you're making a good argument around flexibility for folks to have more of that. And I wondered if you guys could talk a little bit about, for us as fiduciaries, as you hear staff talking about this, concerns, thoughts, can you advise us on how you feel about delegating more authority? It makes sense to me. It sounds like more flexibility for our staff sounds good. But in the realm of delegating so much authority, can you just give us some your thoughts, concerns?
Sharon, I'm glad you asked for that because I was going to make sure that the committee looked at the memo from Makita on INV 186. There are 4 key bullet points and themes that are highlighted there relative to what's being asked, et cetera, and the time frame for adoption. And I think it would be important for that to be on the record. So, Mika, will you address that memo that you wrote to us?
Sure, thank you. Mika Malone with Makita Investment Group. I think that when, as a committee, you're looking at changing anything, right, the hurdle is pretty high for spending time doing the education. I think this is now the second time staff has brought forward the idea of risk budgeting. At the last meeting, you focused on, how many decisions are you making? And I think it was a little surprising to look at how many underlying indexes you're approving as an investment committee. And I believe I made the comment that anywhere you can look for ways to, as fiduciaries, ensure that you're focusing on the most important items. And I think that Scott laid out nicely where 93% of the risk probably is already with you, even if you raise that bar a bit. From that standpoint, I think considering a risk budget really aligns with your overall responsibility. The important thing is you have a portfolio that is executed by your staff within a set of parameters that you feel that you can oversee and measure and manage. I think this is just looking at a slightly different way of managing the portfolio rather than setting explicit targets, which, to be fair, setting targets to areas like active and passive management, as June walked through in global equity, is kind of an absolute decision about what I'd argue is a very flexible set of opportunities in the marketplace. So, active management does much better in certain time periods in certain geographies and is more challenged in other geographies. So where you can think about ways to ensure you're not taking on undue risk, but allow your staff to invest in a way that, from my perspective, adjusting that active-passive ratio among your portfolio is really a relatively minor not a concern, but a relatively minor adjustment from what you're doing day to day, but could really result in the ability of staff to add value to your portfolio over time because that opportunity set changes. So yeah.
Tactical decision versus a strategic one, which seems like that's what our staff should be thinking
Absolutely.
about.
And so I do think it's important to keep in mind that from my perspective, the board and the investment committee are still responsible for these overall policies that set how you're going to judge the effectiveness of how your staff would be executing on your policy. A risk budget lays on top of those MSCI EFA or ACWI targets, Russell 3000 targets, and just allows for kind of underlying implementation flexibility. So I think it's a really, really good topic to be looking at. We certainly believe that more funds are considering this in terms of an approach where you have a strong staff that's executing. And I think that the timeline laid out here, and I know we note in our memo, usually takes 1 to 2 years to really implement something like this. This is a big, big issue, a big change, even though I think the underlying execution would actually change minimally, kind of on a day-to-day basis.
Thank you for that. Any follow-up on that? And I appreciate the final point of developing, approving, and implementing could take between 1 and 2 years, which you referenced in your memo. I thought that's an important point for us to keep in mind. Treasurer Ma?
Oh, I was just, had a question on one of the slides, active versus passive. What does that mean exactly?
Yes, thank you for asking that, and I should have gone over it earlier. When we speak about active in this case, it's performance-wise, so we build a portfolio that looks different from the benchmark because we want to beat the performance of the benchmark. So we've referred to that as active management. For passive, we'll build a portfolio that looks pretty much, if not exactly like the benchmark, so that will match the performance of the benchmark. So it's replicating the performance of the benchmark as passive. We're not taking any excess risk versus the benchmark. And then active, you do have to take some risk in order to try to beat it.
Could I add one thing to that point that I think fits in nicely with this conversation in terms of implementation? The marketplace has shifted a lot just in terms of what qualifies how people think of active management and passive management. So I also think there are a lot of other types of passive management that right now wouldn't have a home in your portfolio in the way that a lot of different pension funds can utilize them. So opening up that flexibility, I believe, would allow June's team to think of more creative ways to be passively managing or kind of enhanced
Yes.
management of the portfolio.
And she's referring to smart beta strategies. So smart beta strategies, there are indexes that are out there, and we manage them passively to what's called a smart beta index. But versus the market cap weighted Russell 3000 index, those smart beta indices do have tracking error, or they do look different and they perform differently. So some people say, well, that's active management, but it's being passively managed to an index, so the lines are blurred.
Can I jump in? And this isn't, it's compounding, and you guys have both, ladies, have done a great job explaining it. It's more for the teachers in the back of the room. A way to look at, they're laughing at me, but they appreciate this stuff. They tell me that, so I'm going to say it. Think of a passive index is the S&P 500. You own all 500 stocks, and you own them right in the right weight. June's mentioning smart beta, and we like to joke about that. That means there's dumb beta, so we don't like it. But an enhanced, and we call it other beta. It might own 490, might own 475, maybe just 450, maybe only 400 out of the 500. An active manager is more like our mutual funds that we all personally invest in. They just might own 30 of the 500. They're picking who they think is the best. So that's part of why this is so complex, and the lines aren't as discrete as Mika pointed out. The board used to make this decision because there was own all 500 or hire a manager that only picks the best 50. Now it's a whole blend of everything from start to finish, and it, as it was pointed out, it changes. There's times to be in one and times to maybe think of the other. And I'll add one note for the board, because I've raised this to you in my evaluation. Our procurement challenges, the fact that it takes us almost well over a year, about 14 months to hire one of those active managers, really becomes an impediment in this issue. So by having those rigid frameworks, it forces us into what I'll call suboptimal solutions at the staff level, because it's going to take us a year and a half to bring a manager in.
Thanks, Chris. Controller Yi?
Thanks, Harry. I really like the idea of the active risk budgeting. I think it's, as you've spoken, it's evolving into becoming, I think, a best practice, and particularly the flexibility that I think it could really accord the team is good. I want to just delve a little bit about some of the discussion around the benchmark decisions of the committee, and what that would mean in terms of, I mean, are these two mutually exclusive things, I guess, in terms of adopting an active risk budget, but also you're feeling the need to have more, I guess, control, for lack of a better word, of the policy benchmarks? And what does that look like? What does that mean? What's the timing of that? And because I just think that, and particularly ones, benchmarks that are focused on investment policy. I just wanted to get a good texture about that.
Yeah. I wanted to address the first point, which is that a risk budget, we think, can help align all implementation, right? So it's the return targets, it's benchmarks, but it doesn't need to align each of them. And so as Mika was saying, we would study this over 1 to 2 years to go through all of those details. And we don't need to change the benchmark process, but we could if we wanted to, delegate more to staff. This would be an additional governance tool or framework which would help enable that. So they don't need to be connected, and all the other elements that we talked about don't need to be connected either. But we do think that it could enable some of the things that we've discussed, but we would study that pretty extensively to inform the board of any and all of the decisions. And that's why, frankly, it would take 1 to 2 years in order to unravel and discuss thoroughly all these issues.
Okay, good. I guess I would want to suggest that maybe with respect to the benchmark decisions that we go a little slower on that, to the extent that a lot of these benchmarks are related to one another. I'd also want to know what the relationship with any benchmark changes would be relative to those that we use for compensation purposes. And so, I mean, there's like a whole kind of unraveling of kind of what the impacts of our decisions that we currently have now. So I would just like to see us move a little bit more slowly on that.
Yes, definitely. I think you're thinking about it the right way.
Okay, thank you.
And I know, Betty, that has come up with other folks asking that same question. So I think what you're raising is well taken. So thanks. Nora.
I think, yeah, it's been answered, but I appreciate the fact that you mentioned that more funds are moving in this direction. But I got stuck on this piece where it says a target level of risk for staff to implement. So what are like the best practices for us to be able to identify what is a target level of risk? What is the right level of target of risk?
Maybe I'll make one comment, and then I think Scott wants to show a slide. From our perspective, that's part of the process. So what typically happens if you're looking at risk budgeting is you take a look at what the current risk level in your portfolio is. So that's sort of you think of the benchmarks that you have and the way staff's been implementing. And I know Scott references a number of about 1.6%. It's kind of the current level in the portfolio. So that's a good starting place, right? To decide whether if that feels like the right number, that may end up being the ultimate solution from a risk budgeting standpoint. But I think there'd be a lot of analysis from staff and conversation around what would be appropriate. And that's typically how it's structured.
And so it's individual by each fund. So there's no sort of best practices of what that number is. It depends on what your portfolio looks like, and that's how you end up deciding.
The asset allocation drives a lot of it, so it would be different for each fund, yes.
Okay, thank you.
And maybe I'll just tack on a little bit, Mika. I was going to say that I think it starts with that strategic asset allocation, which the board is going to set to fund our liabilities. And then as you want us to implement and you want us to outperform that strategic asset allocation, because we'll put it into a policy benchmark. And then you might set a target. We want staff to exceed that by 40 basis points. Then we would have to look at what kind of risk would be acceptable in achieving that target, but also what's linked to what's acceptable for the board in straying from that strategic asset allocation. I think this is what provides so much alignment, is that you would quantitatively tie the staff back in terms of implementation right back to the strategic asset allocation, the most important decision.
And then the accountability piece would be that they would be reporting back to the board on a continuous basis on how this, not only for the 2-year implementation, but after the implementation, so that you put it into the governance process to ensure that we know if this is working or not.
Yes, we think that reporting will actually be more intuitive and easier to understand, because if this is the budget and this is where we are, it's very clear, are we exceeding it, or are we within it? Can I just add one thing? I think this is a great chart that explains your question, because like Mika said, the risk is driven by the strategic allocation. Each asset class has a excess return target. And when you roll that all up at the total fund, our goal right now is to achieve 40 basis points of excess return. But you need to take a certain amount of risk to have a chance at making that 40 bips. And that dotted box shows that it's falling under what you would need to achieve that. So it's the excess return target and the risk driven by the strategic allocation.
Thank you.
Alan, you wanted to add something?
Directly to that question, by adopting this, first and foremost, it is best practice. That's number one. It is being adopted almost across the board with sophisticated investors who have the resources to implement it, because it requires a lot of software, it requires a lot of intellectual creativity and knowledge, and it's not something easily implemented. So the 2-year time frame is probably pretty realistic. But from my perspective as your consultant, the key is by having static targets, you assume the responsibility for the risk in the portfolio. By creating a risk budget, you delegate to the staff the variance between what the expected return is and what in fact is realized. And the staff becomes much more directly related to the output. They can no longer tell you, well, you gave us a risk budget, but we used it well, or we didn't use it well. But the key there is it's a conscious decision by the board to delegate responsibility for the outcome to the staff. And I think that's a legitimate delegation on your part, since in fact you're making those decisions now, and not even necessarily recognizing you're making that decision.
Thank you, Alan. Joy?
Thank you. Thanks for the presentation. And I think I echo the comments of others on the board in terms of supporting, the concept around this and moving in the direction of doing more education, having more discussion alongside our asset allocation discussions. One of the things that I found really helpful, June, was your example of the parameters that you have right now in terms of how you and your team execute their strategy, and what it would look like under an active risk budget, what changes, what doesn't change, and an example of how it could allow you to be more nimble given how the world is changing so much. And I think, you've heard from some of the board members who are interested, but I think just take seriously our accountability and want to understand best how this change will affect what we do and what you do. So I guess I'd also encourage that as we continue to look at this item, having more discussion with the different asset classes around how this would actually affect how how each asset class does their day-to-day work, what changes, but what doesn't change. And then just underscoring Betty's comment about just understanding what this means in terms of benchmarks, particularly those tied to compensation. I think those are two areas that would be helpful as we move forward.
Thanks, Joy.
Thank you.
Keith?
Perhaps this is for later when it comes back to us, but, and partially, or probably all because of my ignorance in this. But I would like to hear sometime the best case against this is, because we're hearing a lot of, and I agree there's a lot of, it sounds pretty good, but as people are thinking about it, it's evidently, it's evolving. And if it's evolving, then it's kind of new. So why didn't people think about this before if it makes so much sense? So as part of the analytical approach to it, I didn't want to hear, what are the potential drawbacks to this? Because we should know what they are. So sometime in the future, when it comes back to us, I'd appreciate that.
Thanks, Keith. I don't see anyone else in the queue, so I'll try to summarize. Is there anybody who hasn't spoken that would like to? Okay. My sense is that the committee would like you to continue with the study and education of this movement. I think Keith's comments are spot on. I think it would be helpful, even if it's a short summary as to what are the cons and risks associated with this approach. What are the naysayers saying? I would lend my support to Joy's comments around, I thought your example, June, of what it actually means now and what the change would be for each asset class to get some examples, I think is very helpful. Clearly, the linkage to benchmarks and potential impacts on compensation is important for us to understand. So I think that's it. Did I miss anything, Betty? Did I capture yours as well? So I think those were the takeaways. So look forward to the next presentation.
Thank you.
Thanks. Item 6, the asset liability study, step 2, allocation information item.
Good morning.
Hi, Geraldine.
Geraldine Jimenez, counselor, staff, and part of the asset liability management team. I have Josh Dietrich here. Although it says Scott Chan, this is Josh Dietrich, and Scott Chan's also on the asset liability management team, along with the actuaries and the financial services team. And today we are, is that clever? We're here to talk about step 2. Today really is just information and education to help build on the next steps. And I'll go over it high level here. We do expect this to take the full year. Today, we're giving you some building blocks that will be the foundation of the study. Hopefully in May, you see there you will adopt assumptions. So these building blocks we talk about today will come back and give you risk return, other assumptions for you to actually approve. And those are really important approvals you'll be doing because that it will affect everything we do as far as we model going forward. So again, please, if you have any questions, feel free to ask them today at the end of the presentation so you understand when we come back exactly what we're bringing you and why it's important. In July and September, we will take these assumptions and we'll mix these different portfolio building blocks and hopefully get a lively debate among the board as far as what's most important to you. We will present to you risks such as funding risks, such as valuation risk as far as the total value of the fund, contribution rate risk. Will your decision affect contribution rates? Again, we're looking for then your input, and then we will go back and model more and come back to you based on what you told us. And we're hoping by November, we had enough discussion and various models that we narrow it down to a couple portfolio options, and you're able to approve it in November. And then January, we'll be back with the actual policy and the implementation plan. So that's the asset line. I want to highlight there's a liability line that the actuaries are reporting to the full board, and you will see them in May. They're going to do the valuation for last year and contribution rates, and we are interacting and integrating our analysis and our assumptions all along. So we will be assuming the same inflation rate, which we will bring you in May, that you approve for both the actuaries and the asset modeling. So I wanted to give you that high level so you know that we are definitely collaborating. So we will meet this next formula. So this is how we pay our benefits. It's pretty simple and straightforward, but pretty important. Contributions are both from members, from employers, and the state. And then you have investments and, of course, expenses. The benefits and the contributions are set in statute, so there's actually not a lot of flexibility. And any flexibility you have, the actuaries will report to you at the full board. And that will be, your May report will be really important and focus on that. So in the investment committee, we won't focus on that except give you information about your decisions and how it will impact them. And expenses, there's an assumption the actuaries have, it's 0.1%. It's actually really small, so we won't focus on that. Related to investment expenses, everything we're modeling is net of fees, net of expenses. So that's already built into what we're doing. So the biggest variable is this: 60% of what we want to use to pay benefits is assumed to come from investments. So this decision you make is really important, and as has already been said, over 90% of the variation in return will come from this asset allocation decision. It's a really important decision, and then 60% of that's going to pay benefits. So there you have it. We're trying to spend a lot of time so we all understand this really important decision. So one of the greatest exposures and risk in the portfolio to get the 60% to pay these benefits is growth. We have a growth exposure, and this is a very good example that shows you what it means. So the green lines, or all the bars, are the CalSTRS portfolio return over time since the 80s. Green is really exciting, it's positive return. And the red, not so exciting. As you can see, there were pretty large drawdowns in the 2001, 2002, then 2008, 2009. All of these really, right, are linked together that actually pay benefits. I want to show you this. This is the S&P 500, which is around 500 of the largest stocks in the United States. Notice how closely they track. That just shows you the growth risk that's in the CalSTRS portfolio, and one we have to be aware of as we model and consider. Consider how we take advantage of the green and how we protect from the red. And that will be a major focus of this study. So with that, every asset in the portfolio or asset class has a role. And if you can see on the left, the growth risk are the equities, so the stocks, both private and public, they have a role to provide that growth and appreciation to get us to 60%. And then on the far right, you can see there's some that move in a different direction than the growth assets. And so this study will look at combining all these different assets to come out to the optimal portfolio. So at this point, I'm going to hand it off to Josh, who leads our risk management for the investment branch.
Great, thank you. So one of the things that we really focused on in this memo, and sort of one of the main objectives of this item, is sort of thinking about this step as setting the menu or the investment opportunities that we have in the portfolio. So describing where we invest and what the roles are of these different areas, these different asset classes. And so some of you are, and many of you are familiar with sort of this asset class framework that you see here. It's sort of aligned with what we have now in terms of public equity and private equity and real estate, these asset class categories. But for the purposes of this study, and particularly in the early stages of modeling, we think it's helpful even to step back even a little bit further from the asset classes and look at some of the common connections that you have within some of these asset classes. So I'm going to have one slide sort of walk through each one of these big categories of economic growth, real assets, and diversifying. But the way I think about this is, again, it's sort of the opportunity set, the menu of investment options that we have, and then really thinking about the big picture drivers, because we're doing this study with a very long-term horizon. We have a long duration for our liabilities, and we model asset returns over a very long period. So what are the biggest sources of risk and the biggest drivers of return for these assets? And we can go even sort of farther up from the asset class level. So the first category that we talk about is this economic growth, and it's the biggest piece of our portfolio. It's the biggest source of risk and where we expect to earn return. All of those little darker green boxes are sort of different ways that we access that, and there are going to be small exceptions to each one of these. But the way that I think about this category is we own companies, really, at the end of the day. So they could be public or private. They could be in different geographies. They could be in different stages of their growth. It could be a new startup. It could be a mature industrial company. But at the end of the day, this category is largely about having ownership stake in companies and participating in their growth and their earnings over the long term. And so by accepting that risk, we think things are going to be good over the very long term. But when things get bad, if the economy turns south, we accept that risk. But by accepting that, we earn high returns. And that's sort of what this bucket to me is all about. It's about ownership in companies for the long term. And so that's sort of the economic growth bucket, and we include public and private equity in there. Another sort of big picture way of thinking about this is this real assets and inflation. And you'll see when we come back in May with the capital market assumptions and the expected returns in particular that these will have we expect returns a bit lower than what we get from economic growth. The common theme, again with some small exceptions here, is we own physical assets. It could be an office building or an apartment complex or a port or a ferry, things like that. But at the end of the day, these are largely physical assets that produce income for us. And we expect that those assets will appreciate in value a little bit, but particularly provide income, and income that will adjust with inflation. So if we get periods of higher inflation, that over time, those assets will give us some protection. They give us a bit of return as well. We do get some exposure to economic growth risk here as well, but the bigger driver is sort of these sources of income that come from physical property, physical assets. So that's sort of this real assets, and inflation includes real estate and inflation sensitive, the biggest piece of that being infrastructure.